When a business with a multi-decade track record of crushing the stock market indices announces that, hey, we are going to do a special situation and spin off part of their business, it should get you interested. It certainly has me interested. I own, at the time of this video publication, both some stock in Brookfield Corporation as well as Brookfield Asset Management. And in this video, we're going to talk about the spinoff of Brookfield Asset Management. What's the valuation? What should investors consider about future returns from here? If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy educational investment videos, please make a point of hitting that subscribe button. So let's understand, well, wait a second, what is a spinoff in the first place? Well, Joel Greenblatt, very successful investor, he wrote a wonderful book called You Can Be a Stock Market Genius Even If You're Not Too Bright, something like that, calling out how occasionally you have, and by the way, he backed Michael Burry with his hedge fund. He also ran his own hedge fund, Gotham Capital, and compounded at like 40-50% for a decade. So very, very successful investor. He called out in that book that there are several parts in the market that sometimes are mispriced. Spinoffs are one of these situations, can be. You should analyze what happens where a parent company will spin off an asset saying, hey, we don't think the market is recognizing the value of this business, so let's spin it off. And oftentimes what happens is shareholders go, wait a second, I don't want this spun off asset. I just want to own the parent company. And so they end up selling, and it creates this forced selling that causes the spun off asset to look actually really attractive, get very, very cheap, which creates opportunities for those folks that can analyze stocks and say, hey, what's a fair valuation for this? So what is going on with Brookfield Asset Management? What's going on with the spinoff? Well, to understand, so Brookfield, the corporation, is distributing 25% of their asset management business. And the way they're doing is for every 1 share of the manager, for every 4 shares of Brookfield. So 1 share of BAM for every 4 shares of BN. Now, this might be a little confusing to folks because Brookfield Corporation, which now goes by the ticker BN, was formerly trading as BAM being the ticker. That's no longer the case. Now it's BN, and they're distributing 25% of their interest in the asset manager, and now that is going to have the ticker as BAM. And so BAM is this is the new BAM, and that's what's currently trading around 25% of their asset management business. And this is very interesting because it's a spinoff. Now you have 2 separate businesses to look into to say, hey, what's the value here? Thinking about the asset manager. Now, keep in mind, Brookfield Corporation is not just this asset management business, which we'll talk about in a second, but also has fast-growing insurance operations as well as a huge investment portfolio of things that Brookfield has invested in, and that's what's partly driven their exceptional returns over time. Now, looking at this asset management business, $400 billion in capital managed roughly, spread across various different assets from infrastructure, private equity, credit. They bought a majority position in Oaktree, which is one of the distressed debt shops out there. So this is a very interesting, globally diversified private investment portfolio. And when you look at Brookfield Asset Manager, the spinoff, or Brookfield Asset Management, BAM, the way you should think about their earnings power going forward is that 100% of the fee-related earnings, and they'll also get 2/3 of the performance-related fees. Now, most investors prefer to focus on the fee-related earnings because that's very, very sticky. You're getting, let's say somewhere between 0.5% and 1% of the assets under management each year in terms of a fee that comes in, year out. And so that is like an annuity type of business. That is a very highly valued business. And then the performance fees, that'll be a lot more volatile. Let's say you charge 15, 20, 25% performance fees. That's typically, hey, you deliver, let's say you increase 20% in value. Well, you're getting, let's say, a 20% fee of that value creation. That's this carried interest. But it doesn't necessarily happen year to year. It's going to be lumpy depending on when they trim their portfolio or find, appropriate exits. So not only do you have this earnings power from stable fixed fee business, which they estimate to be around $2 billion in free cash flow, which is very interesting. They're also saying, yeah, this is actually going to be a very clean balance sheet with roughly $3 billion in cash and investments, no debt. And they're saying, yeah, we're also going to be paying out roughly 90% of their distributable earnings to shareholders, saying, hey, this might be, based on the current price for BAM, roughly a 3 to 4% yield currently where it trades. We'll see where it comes out, but that's roughly where it is based on how I'm penciling it out. And so you have 3 to 4% yield plus potential growth. Management thinks that they more than double the business over the next 5 years just from their fee-related earnings. And it's worth understanding that they're saying, yeah, we think our fee-related earnings is around $2 billion, and none of the current carried interest is in that. So none of their performance fees. So any of their prior funds, yeah, that's not going to be here in this new asset manager. It'll only be performance fees from new funds that they launch, and that'll be 2/3 of the performance fees that go to the asset manager. And so the question is, well, what's Brookfield Asset Management worth? Is there this dynamic where it's cheap to buy Brookfield Asset Management stock? First, if you're looking to take charge of your investment journey, consider unrivaledinvesting.com for compelling investment ideas, real-time portfolio updates, and our exclusive Discord server available for annual subscribers. Also recently launched 2 new investment courses for enterprising investors looking to learn more about valuing businesses and understanding financial statements. That's all at unrivaledinvesting.com. In full disclosure, not financial advice, and at the time of this publication, I did own stock in both Brookfield Corp as well as Brookfield Asset Management. And so once again, in this video, I'm going to focus on Brookfield Asset Management, which is the spinoff. That is traditionally the asset that becomes cheaper. In this case, I'm not sure that's actually going to be the case, but in this case, I'm just going to focus on Brookfield Asset Management, leaving Brookfield Corporation BN as a separate focus for my subscribers at unrivaledinvesting.com. So looking at Brookfield Asset Management, currently around $33, $34 a share, roughly 400 million shares outstanding. That implies this asset manager business being valued around $14 billion. Now, keep in mind, this is only 25% of the asset manager. This isn't the full 100%. This is only that 25% interest in the asset manager. So that implies if the whole thing were public, getting this fees, it would probably be worth between $50 and $60 billion, roughly, based on how you're seeing here. Now, they're saying that this is based on the figures they provide in their presentation, saying, look, they're going to have $2.8 billion in net cash on their balance sheet, and there's going to be annual free cash flow of around $2 billion. Now, once again, you should understand, and there's currently going to be 0 from performance fees, but that'll probably increase over time. Right now, I'm not giving them any credit for. I'm just saying right now, over the next 12 months, how should we think about the economics for BAM stock? And recognizing that BAM the ticker, only owns 25% of the asset manager. So that $2 billion in annual free cash flow that they call out, that's only going to be around $500 million, give or take. I'm doing plus or minus 50 million. And so thinking about where this is, over the next 12 months. And so that implies, okay, so you have this business, that's represents 25% of the asset manager that's valued at $13-14 billion, generating around $500 million in free cash flow. So that implies that it's trading somewhere between 25 and 30 times. So that is the market's way of saying, hey, this is a very good business. We're going to assign a very full multiple for it because you've told us you're going to return that capital to shareholders. And that's part of the reason why it's very stable, very sticky, growing. And your shareholders should expect, hey, if you're going to be paying out, let's say 90% to shareholders, that you're going to be getting around 3 to, let's say, close to 4% based on that free cash flow multiple. So you're getting 3 to 4% a year potentially, and then factor in growth from assets under management, maybe some growth from future funds, from future performance fees. And so over the next 5 years, I'm penciling out somewhere between 12.5 and 17.5. So not giving, let's say, full credit to their business, more than doubling like they're suggesting. I'm saying, hey, let's pencil out 15% as sort of the base case, and assuming a little bit of multiple contraction, saying, hey, maybe in 5 years from now, you're only going to assign 20 times, give or take, to that multiple, which obviously I think this is I think having a annuity-like business where you're paying out steady amounts of free cash flow, you can say, hey, this is like a 90% payout ratio, and it's tied to assets under management, and assets under management are growing each year. That type of business, it should have a premium. So maybe I'm being a little too conservative here, but thinking about a range of multiples, that gets to around 14 to, let's say, a little under $30 billion valuation over the next 5 years, plus that dividend that shareholders, I think, should be expecting. And so you're effectively penciling out low single digits to nearly 20% return for BAM stock in the future. So that's part of the reason why I own Brookfield Asset Manager. But I also think that it's quite possible that Brookfield Corporation, with all this noise, actually might be even cheaper. The problem with Brookfield, in my opinion, is that the results are just so incredibly complex to dive into, to peel apart. For example, the hypothetical valuation I was just showing, that is relying heavily on the figures management provided, such as, hey, this is the annual free cash flow. So it is trickier, in my opinion, than, let's say, looking at a simple business. Let's say, looking at an advertising business where you could say, oh, this is the free cash flow and very easily calculated. Here, their balance sheet, their financial statements, they're much more complex. And so you do have to rely a lot on management for a company like this. You have to sort of bet on the jockey and say, hey, I sure hope they're not doing anything fraudulent, because there's so many moving pieces here, and it'd be very easy, to do something that's problematic. So I own a stake in Brookfield Corporation as well as Brookfield Asset Management. And if this video has been helpful for you explaining the thoughts around Brookfield Asset Management, its current valuation, its potential in the years ahead, please make a point of hitting that thumbs up, hit that subscribe button. Also, one more quick point, I did call out with, looking at Brookfield Asset Management, the hypothetical valuation framework. It is worth understanding, if they don't deliver on this growth, if they don't deliver on that 2 billion, in annual free cash flow, and they don't start growing their performance fees, then I would say, there's a good chance you could see an even lower multiple than I'm penciling out, or you just won't see these types of attractive returns. So like all valuation frameworks, it really depends on seeing management execute. And that's what I'm looking for. That's what everyone should be looking for a great team where you can rely on them and they have a track record of delivering. In this case, Brookfield does have a track record of delivering, but the business is getting particularly complex. I hope this video has helped sort of clear up some of the complexity. Thanks so much for tuning in.